Welcome to Trade Tactics TV. In today's video, we're diving into two important chart patterns, pattern diamond and pattern cat's ears. Whether you're a beginner or an experienced trader, this video will cover everything you need to know about these powerful patterns and how to use them in your trading strategy. If you enjoy the content, don't forget to like, subscribe, and turn on the notification bell so you never miss out on our latest trading tips and insights. Thank you for watching. The diamond pattern is a rare but powerful chart formation used in technical analysis, often signaling a potential reversal in the market. Here's a detailed breakdown of the pattern and its characteristics. What is the diamond pattern? A diamond pattern resembles the shape of a diamond on a price chart, and it typically forms after a strong trend, either bullish or bearish. The pattern indicates an impending reversal, where the market shifts from a previous trend to the opposite direction. Characteristics of the diamond pattern. Higher time frames. The pattern is generally more reliable when it forms on higher time frames, above 1 hour. The longer the time frame, such as 4 hours or daily, the stronger the reversal signal tends to be. The extended time frame allows for more price action, giving greater weight to the pattern. Preceding trend. The strength of the diamond pattern depends heavily on the clarity and duration of the prior trend. The longer and more pronounced the trend leading up to the diamond formation, the more reliable the pattern becomes as a reversal signal. A sharp trend increases the potential energy for a reversal once the pattern is completed. Large candles breaking one side of the diamond. During the formation of the diamond, large candles, with little to no shadows, that break one side of the pattern further validate the strength of the potential reversal. This indicates that there is strong momentum in the market, supporting the idea that the pattern will be followed by a significant move once it's confirmed. Pullbacks and key support/resistance levels. If the price pullbacks during the formation of the diamond coincide with major support or resistance levels that have been tested in the past, it adds further confirmation to the pattern. These key levels act as strong barriers, reinforcing the likelihood that the pattern will work out as expected. For instance, if the market repeatedly touches a support level during the diamond formation, it suggests that the support will hold, leading to a potential reversal. How the diamond pattern develops. Expansion phase. In the initial phase of the pattern, price action becomes volatile and the trend widens. This widening creates the first part of the diamond shape. Contraction phase. After the expansion, the price action begins to contract, forming the other side of the diamond as the trading range narrows. Confirmation and entry into the deal. Breakout point. The diamond pattern is confirmed once the price breaks out of the converging trend lines that form the shape. The breakout could happen either to the upside or downside, depending on whether it's a bullish or bearish diamond pattern. Timing the entry. Traders typically enter the deal after the breakout, placing their trades in the direction of the breakout reversal. The breakout candle should close outside the boundaries of the diamond to confirm the validity of the pattern. Risk management. A stop loss is usually placed outside the opposite side of the diamond from the breakout to protect against false breakouts or the pattern failing. The diamond pattern is a powerful reversal signal, especially on higher time frames. It gains strength from preceding trends, large candles breaking the pattern's boundaries, and pullbacks that align with major support/resistance levels. This makes it a highly useful tool for traders looking for reversal opportunities in the market. General stop-loss placement for the diamond pattern. Opposite side of the breakout. The most common approach is to place the stop-loss slightly outside the opposite side of the diamond pattern from where the breakout occurs. For a bullish breakout, upward breakout, place the stop-loss just below the lower boundary of the diamond, typically where the last swing low is. For a bearish breakout, downward breakout, place the stop-loss just above the upper boundary of the diamond, near the last swing high. Distance based on volatility. Consider the cat's ears pattern is a bearish continuation pattern that typically appears during a downtrend. It visually resembles the shape of a cat's head with two ears, indicating a temporary pause in the trend before it resumes downward. Here's a detailed breakdown. Characteristics of the cat's ears pattern. Downtrend, initial phase. The pattern forms in the middle of a strong downtrend. Before the pattern emerges, the market has been declining with clear bearish momentum. Pause, consolidation phase. After the downtrend, the price pauses and fluctuates sideways, showing a lack of clear direction. This consolidation can be seen as a period of indecision in the market. Left ear formation. The price suddenly spikes upwards, forming what is known as the left cat's ear. This is a short-lived bullish move that quickly reverses and returns to the consolidation zone. The left ear resembles a brief price rally that doesn't hold, signaling that buyers don't have enough strength to reverse the trend. Scalp, middle of the pattern. After forming the left ear, the price once again fluctuates sideways in a range. This part of the pattern is referred to as the scalp, which represents indecisiveness and hesitation. No strong upward or downward movement occurs during this phase, and it mirrors the head of a cat. Right ear formation. Similar to the left ear, the price makes a second, brief upward push, forming the right cat's ear. This second bullish attempt also fails to sustain, and the price quickly reverses back to the previous levels. Breakout, continuation of the downtrend. After forming both ears and the scalp, the price eventually breaks out of the consolidation zone, but instead of moving upward, it breaks downward, continuing the initial downtrend. The breakout confirms the bearish continuation, signaling that the market will resume its previous bearish momentum. Key features of the pattern. Failure of buyers. The two upward price movements, forming the ears, show buyers attempting to reverse the downtrend, but failing twice. This failure is a key signal that the market is not ready for a bullish reversal. Bearish signal. Once the second ear forms and the price breaks down from the consolidation range, it confirms the resumption of the downtrend. Psychological implication. The pattern reflects market hesitation followed by the realization that the bearish trend remains dominant. Entry strategy. Entry point. Traders typically enter a short position after the price breaks down below the support level formed during the scalp or consolidation phase. This breakout signifies that the downtrend is resuming. Stop loss placement. A stop loss can be placed just above the right ear or the scalp level. This ensures protection against false breakouts where the price might temporarily move up before continuing downward. The cat's ears pattern is a bearish continuation pattern, signaling that a downtrend will likely resume after a brief period of consolidation and two failed bullish attempts. Traders can use this pattern to identify continuation points in a downtrend, capitalizing on the bearish breakout when the price moves downward again. When trading the cat's ears pattern, identifying the correct target profit is essential for maximizing gains while managing risk. Here's how to approach it. 1. Measure the height of the pattern. The height of the cat's ears pattern is the distance between the lowest point of the scalp, the consolidation zone, and the highest point of either the left or right ear, whichever is higher. Target 1. A common target for the pattern is to project this distance downward from the breakout point, the point where the price breaks below the consolidation. This provides a measured move, which reflects how far the price might drop after the breakout. Calculation. Height of the pattern, in pips or points, equals highest point of the ears minus lowest point of the scalp. Project the same distance downward from the brie. Best time frames. 15-minute to 1-hour time frames. The 15-minute to 1-hour time frames are commonly used by day traders and short-term swing traders for the cat's ears pattern. These time frames offer a balance between quick price action and enough data to confirm the pattern's formation and breakout. Why? On these time frames, you'll see quicker price movements and more opportunities for the pattern to form during the day, making it ideal for capturing short to medium-term trades. 4-hour time frame. For swing traders, the 4-hour time frame can be an excellent choice. On this time frame, the cat's ears pattern will reflect more significant market pauses during a downtrend, signaling larger moves when the downtrend resumes. Why? The 4-hour chart smooths out some of the noise and gives a stronger confirmation of the pattern, making it useful for swing trades that last a few days to a week. 2. Shorter time frames, 1 minute to 5 minute. For scalpers or very short-term traders, the cat's ears pattern can also form on the 1 minute to 5 minute charts, especially in highly volatile markets like Forex or futures. Why? On these shorter time frames, the pattern may offer quick trades with small profit targets. However, the downside is that these shorter time frames can be prone to noise and false signals, so traders must be cautious and use tighter risk management. 3. Larger time frames, daily and above. While the cat's ears pattern can theoretically form on larger time frames like daily or weekly, it is less commonly seen on these higher time frames. Why? The pattern typically reflects shorter-term market hesitations and quick pullbacks, making it more suitable for time frames that capture intraday or multi-day price action. On larger time frames, this pattern might lose its precision as price action becomes more smoothed out and trends are less affected by short-term fluctuations. Conclusion. Ideal time frames: 15-minute, 30-minute, 1-hour, and 4-hour charts are the best time frames for spotting and trading the cat's ears pattern, especially for short and medium-term trading. Scalping time frames: 1 minute to 5 minute for scalping, though more prone to noise. Higher time frames, daily/weekly, less reliable for this pattern as it tends to be a reflection of shorter-term price consolidation and reversal attempts.